Welcome to The Explainer. Okay, today we are unpacking something really fascinating. We're going to look at how a super simple, highly accessible strategy took a literal child's pocket change and turned it into one of the greatest fortunes in human history. So let's just dive right into this incredible story of discipline, time, and the legendary investor who built an absolute empire. Now, I want you to picture $114. Imagine being an 11-year-old kid, right? You've got just $114 to your name. Now, instead of blowing it on candy or toys or video games like any normal kid would, you decide to put every single cent of it straight into the stock market. Kind of wild, right? Well, that exact boy grew up to be Warren Buffett, and today his net worth sits at over $100 billion. It's honestly an unfathomable amount of wealth. But the path he took to actually get there, that's what we really need to focus on today. So you're probably wondering, how exactly does pocket change become a $100 billion fortune? I mean, he didn't invent some massive tech empire like an Amazon or a Facebook. Instead, he used a principle so straightforward, so basic, that literally almost anyone can apply it to their own lives. Now, Buffett's journey was anything but an overnight success story. His business mindset kicked in remarkably early. I mean, at just 6 years old, the guy was already buying 6 packs of Coca-Cola and selling the individual bottles for a profit. At 11, he buys that first stock. But you know what the most surprising fact is? Over 99% of his wealth, 99%, was actually generated after his 50th birthday. But, before the billions started rolling in, there was a really crucial, honestly, pretty painful learning moment. When young Buffett bought those first shares of Citi's Service Preferred, he nervously watched the price drop and, well, he panicked. The second it recovered to just a tiny profit, he sold it. He was feeling pretty proud of himself, only to watch an absolute horror as the stock just skyrocketed right after. He realized right then and there that he had let impatience rob him of a massive return. That painful realization, though, it totally laid the groundwork for his entire future. Fast forward a bit to Columbia University, and he meets his mentor, Benjamin Graham. Graham wrote The Intelligent Investor, and he introduced Buffett to this revolutionary concept of value investing. Basically, it's the art of buying excellent, fundamentally sound businesses at reasonable prices, and then, here's the kicker, holding onto them for a very long time. Now, adopting this required a massive mental shift. Graham taught Buffett that we really need to treat the stock market exactly like our favorite retail store. Think about it. When a store puts its absolute best items on sale, what do? We get super excited and we buy. So why on earth do we panic when great stocks go on sale? We should be viewing market drops not as some terrible disaster, but as a fantastic discount on excellent businesses. Buffett put this theory to the ultimate test in 1965. He buys this struggling textile mill called Berkshire Hathaway, basically just because the price was an incredible bargain. But here is the genius part. Instead of trying to save a dying industry, he completely pivoted its whole purpose. He used its remaining cash to transform it from a failing factory into the ultimate investment powerhouse. So he takes the textile company's profits and he uses them to buy stakes in fantastic businesses. We're talking companies like Coca-Cola, American Express, and eventually Apple. And he treated these investments like seeds. He wasn't sitting there day trading them. No, he was planting them, watering them, and just patiently letting them grow into these massive trees over decades. And because he utterly refused to touch those investments, this staggering mathematical twist occurred. Like I mentioned earlier, a mere 1% of his immense wealth was actually created before his 50th birthday. Let that sink in. More than 99% of Buffett's incredible, mind-boggling fortune came after he turned 50. This right here dramatically illustrates the totally unstoppable math of compounding. It's a concept famously referred to as the eighth wonder of the world by Albert Einstein. Now, whether Einstein actually said that or not, honestly, the principle remains universally true. Time is, without a doubt, the ultimate multiplier of wealth. We call this the snowball effect. Compounding works exactly like a snowball rolling downhill. At first, the growth seems so frustratingly slow. You're barely seeing anything. But as it gathers more snow, the snowball gets bigger. And as it gets bigger, it gathers even more snow, until its size and its momentum become absolutely explosive. So the core mechanism behind all his billions, it wasn't about predicting the future. It wasn't about possessing some superhuman intelligence. Rather, it was just having the extraordinary patience to simply stay invested, decade after decade, while most other people panicked and quit.
Okay, so how can we actually apply this to our own lives? Well, we can extract 5 concrete lessons from Buffett's story. Think of these 5 steps as a sort of playbook for everyday, ordinary investors. They really form the foundation of his entire philosophy.
First up, begin as early as possible. Just like Buffett starting at age 11, the earlier you start, the bigger your snowball can get. And second, invest in what you actually understand. Seriously, if a business model is way too complicated for you to just easily explain to a friend, you probably shouldn't be putting your hard-earned money into it.
Third, be patient. The stock market is, at the end of the day, a tool that transfers money straight from the impatient to the patient. You just have to ride out the bumps. And fourth, keep learning. Even today, as a literal multi-billionaire, Buffett notoriously spends hours reading, like up to 500 pages a day, just to continuously expand his knowledge. It's amazing. The fifth and final lesson is to completely shift your mindset. We have to stop worrying about what's going to happen in the news next week and instead focus entirely on what will happen over the next decade. Changing your time horizon, it literally changes every single thing about your financial decisions. Listen, you don't need a revolutionary idea. You don't need some massive inheritance to build wealth. Success so often comes from just doing simple things consistently for a really, really long time. So I guess the only thing left to ask yourself is, what will your snowball be? And are you patient enough to let it roll?